The most important lesson: price is what you pay, value is what you get. I want to talk to you today about the most important distinction you will ever make as an investor. It is the difference between two simple words, two concepts that the market constantly tries to confuse. Those two words are price and value. I often say price is what you pay, value is what you get. This sounds simple enough that a child could understand it. Yet, in the world of investing, this fundamental truth is forgotten more often than it is remembered. The entire game, the entire pursuit of intelligent investing, boils down to consistently paying a price that is less than the value you receive. Let's be perfectly clear about what these words mean. The price is the number on the ticker tape. It is the number you type into your brokerage account to execute a trade. It is a simple, objective, and very public fact. It is determined by the momentary whims, fears, and greed of millions of other market participants. It is what the emotional and often irrational Mr. Market is offering you on any given day. The price is transient. It flickers and changes by the second. The value is something entirely different. It is not a number on a screen. It is your careful, reasoned estimate of what an entire business is worth. It is the sum of all the cash that business can be expected to generate for its owners over its entire remaining lifetime, discounted back to today's dollars. Value is intrinsic. It is rooted in the real-world assets of the company, its factories, its brands, its customer relationships, and most importantly, its ability to generate profits. Value is stable. It does not change because the stock market had a bad day or because a pessimistic headline crossed the wire. The speculator is obsessed with the price. He buys because he believes the price will go up. He is betting on the behavior of other people. He is playing a game of greater fool theory, hoping that someone else will come along and pay a higher price for his asset, regardless of its underlying worth. The investor is obsessed with the value. He buys because he has calculated that the value of the business is significantly higher than the price Mr. Market is asking. He is not betting on the mood of the crowd. He is buying a fractional ownership in a productive enterprise. He is content to hold that ownership for years, even decades, collecting the profits the business generates, completely indifferent to the daily price quotations. This confusion between price and value is the source of nearly all investment folly. It is why people rush to buy stocks when they are soaring and become terrified to buy when they are falling. They see a rising price and mistake it for increasing value. They see a falling price and mistake it for disappearing value. They are letting the market's manic depressive mood swings tell them what something is worth, rather than doing the work to figure it out for themselves. Think of it this way. If you were buying an apartment building, you wouldn't let the person selling it to you set the value in your mind. You would do your own analysis. You would look at the rents, the occupancy rates, the maintenance costs, the quality of the construction. You would arrive at a figure, the value that the building has to you as a long-term owner. Only then would you look at the asking price. If the price is at or above your calculated value, you walk away. If the price is substantially below your calculated value, you have found a potential investment. The stock market is no different. You are not buying a ticker symbol. You are buying a piece of a business. The fact that it is easy to buy and sell in seconds does not change the fundamental nature of the transaction. It is still the purchase of an ownership stake in a productive asset. This is where our most important tool comes in, the margin of safety. Because estimating value is an imperfect science, because the future is inherently uncertain, we must never pay a price that equals our estimate of value. That is far too risky. What if we are slightly too optimistic? What if the economy hits an unexpected rough patch? The intelligent investor only buys when there is a wide gap, a margin of safety between the price he pays and the value he receives. If I calculate that a business is worth 100 per share, I do not buy it at 95. I wait patiently for a price of 70 or 60 or even less. That discount is my buffer against error. It is my insurance policy. It is what protects my capital from permanent loss. The crowd, driven by emotion, consistently does the opposite. In times of euphoria, they pay 120 for that 100 of value, convinced that the good times will never end. In times of despair, they are too frightened to buy at 60, convinced that the value has evaporated. They are buying high and selling low, the exact opposite of what we aim to do. Our strategy, therefore, is one of profound patience and discipline. It requires standing apart from the crowd. It requires doing the hard work of reading annual reports, understanding business models, and thinking like an owner. It requires the emotional fortitude to be greedy when others are fearful, to see a falling price not as a threat, but as an opportunity to buy more value for less money. The market will offer you prices every day. Your job is to know values. If you don't know how to calculate the value of a business, then you have no business buying its stock. Stick to what you understand. Your circle of competence may be small, but that's fine. It is far better to be approximately right in a business you understand than to be precisely wrong in one you don't. In the long run, the stock market is a weighing machine. It may act like a voting machine in the short term, tallying up popular opinion. But eventually, over years and decades, the true value of a business will be reflected in its stock price. The investor who buys at a price below value simply waits for the weighing machine to do its work. He is not concerned with when it will happen. He is confident that it will. So, remember this simple but profound truth. Let it guide every investment decision you ever make. The price is what the market is offering. The value is what your intelligence and diligence can discern. Your goal is to pay a price that is less than that value, and to do so with a margin of safety that protects you from your own inevitable miscalculations. Master this one principle. Understand the crucial difference between what you pay and what you get. Do this, and you will have learned one of the single most important lessons in all of investing.